All right. Tonight we are so very excited for our group who are interested in trading. This is sort of off the beaten path, but it's going to bring you right back on the right path, okay? Tonight we have three special experts, and together they have over 25 years of experience, and they are willing to share this experience with us. So first of all, I'd like to thank Mr. Jimmy Cuffey for last week being with us. Thank you so much, Mr. Cuffey. This week we have a newcomer, Mr. Eric McBride, and of course we have our Mr. World of Charity, our fearless leader, Delvin Wright. So with that, I'm going to turn it right over to Delvin. Delvin, take it away.
Hello, thank you. How's everybody doing tonight?
Red hot and rolling.
Oh man, I'm shocked to see these two faces right here. I didn't think y'all were gonna make this call tonight.
Oh, you now you know if you want to get it done, you ask us and we will get it done. Okay.
Hey.
A trooper delayed us a little bit though on the way back.
Yeah, I was just gonna say I'm not the only one that know how to tear them roads up, huh?
Tear them up is right.
It's a September 14th thing. That's all it is.
Yes, it is. Yes, it is.
Well, guys, I'm excited and glad to be here. We have a lot to go over and some good stuff to go over too. I think we got a chance tonight with me being able to be focused and settle down and sitting down somewhere where I was driving last week. Now I can kind of focus and kind of zoom in and be more productive to the call. So, yeah, I want to get started. I know we said we're going to try to move over and do it on Sunday night. And I know Sunday may not be the best evening for some people, but the fact that we're recording this, that means anybody can watch it at any time. So Sunday worked out good this time. And, before we jump off, we'll figure out when the next one's going to be. But to get started, I want to first say that Mr. Cuffey may not be able to join us tonight. He had a family emergency, and he may get on, he may not. I told him to take care of family first. We got this. He can always come in on the next call. But what I do have for you guys is the other part of this dynamic team crew clique that's been trading together for years and years and years. So what I mean by that, guys, is that I've been knowing this guy my whole life. We've been friends since elementary, since grammar school. Way before we knew what getting in trouble was. We've been friends.
Oh, really?
Well, but yeah, seriously, man, we know this is a long time friend, not just a long time friend, one of my best friends in life. And it really warms my heart to have him and Jimmy on this platform doing this with me, because we've done this since we first learned how to do this together. We've always done it together anyway. So I felt like, why not bring them in on what we're doing? Because anytime I'm doing anything, we end up doing it together anyway. So I want to first tell you what I'm talking about. My friend named Eric McBride been trading with me since I very first started trading. And this guy, not only is he a sharp guy, he's a very, very successful businessman. He's been in business for himself for long as I guess right after school. Tell you the truth, he went to the military, but after he came home, he's been in the business for himself ever since. And he's very, very successful in the hair industry. But one thing that we all had in common, all three of us, what made us click and bond, is that we all were entrepreneurs from a very early age. We knew that. That's what our conversation was about. Well, most of our other friends were talking about other stuff or doing other stuff. We had this in common. We kind of already knew we wanted to be entrepreneurs, because we just didn't work out with being employees. So this was down our alley. when we ran across this trading, like what? This was something that we was trying to figure out what we were gonna do to not be in the world doing something that we didn't really want to do. So when trading came along, it just worked, and it was something that we just gravitated to. So, guys, I just want to take a second, bring on somebody who know everything about this market that I know, and you'll see just what I mean about how sharp he is. My long time, one of my best friends, Mr. Eric McBride. Can you come on, bro?
Hey, hey, how's everybody doing? I hope y'all can hear me.
We can.
Yes,
Okay. I'm excited. You know, anytime we talking about trade, you know, it's always an exciting time. You know, like Delvin said, we've been trading for such a long time, and you know, running into, I'm not sure how far you all got, but running into this business. First of all, I own a business called E&P Distributors, and what we do is we distribute a product called Design Essentials, and that's actually it's a family-owned product, but I'm one of the distributors here in Atlanta and been in business here for about 25 years or so with E&P Distributors. And like Delvin said, when we came across trading was one of those things that changed our life. I mean, literally our lives changed the moment that we got that Twampum manual. And what really stands out is the fact that when we first started reading the material, and when we discovered that the hardest part of opening up the business, because that's exactly what it is, it was like opening up a business. And so it was almost like when we saw that the hardest thing that there was to do was to know when to take profits. I mean, I think we really looked at each other and realized that we was on the right plateau, and that this is where we needed to be, and we needed to find out more information. So, you know, so it just became a thing that we became obsessed with, you know, wanting to learn more about the terminology and different things. And I know you remember, Delvin, we would go down, you know, sit at Lenox Mall, you know, like we was the biggest businessmen in the world and stuff, and just sit down there with our materials and stuff, and just study commodities and stuff. And it just became a way of life, you know, for us. So I encourage anybody that's on the brink of trading or wanting to learn how to trade, you know, don't let the TV, don't let what you've heard in the past, don't let, you know, any book or anything scare you away. It's you know, it's one of the I would say it's one of the easiest skills that you could actually pick up. You know what I mean? You know, once you really jump into it, you really kind of say to yourself, it's really one of those things where you say to yourself, it's got to be more to it. I mean, you know, it's got to be more to it. So you go looking for more to it, but it's no more to it. It's no more to it other than really learning how to leverage money. And, you know, with commodities, with stocks, you know, one of the biggest things that we can do is leverage money, especially if you're not one of the big boys who just have millions of dollars to play in the market. So I'm excited about, you know, whatever the conversation is that we're going to have tonight about, you know, getting started with the business of trading commodity. And, you know, one of the first things I will say is, if you don't start with the mindset that it is a business from day one, I promise you, if you don't do nothing else, you'll fail. It is truly operates exactly like a business, and you have to take it there and really pay attention to the money, because we're talking about liquid, we're talking about liquid money, we're talking about risk capital. So, you know, everybody wants to make money, you know. So the thing is, you know, when we're talking about being disciplined with the money, you know, if you're starting an account, I hope I'm not jumping ahead, Delvin, but if you're starting an account, you know, and opening up, getting your account open, whatever you start with, you want to know right away, 10%, the golden rule is 10%. You know what I mean? You know, so if you're starting off with $1,000, you know that $100 is all that you can risk for your very first trade. So just keep that in mind when you're getting your accounts open, not to look at the fact that, you get kind of, it's so easy to get sidetracked. You want to keep a plan. You want to establish a plan and stay on that plan. No matter how simple it is, you want to stay on that plan. Making $50 a day, can turn out to be very good supplemental money, just like, making $100 a day. So you want to get a plan to where you just really trying to not kill the market. That's when you hear about the stories of everybody that lost everything that they had, or you hear people say, "Don't trade commodities. Don't do that. You're gonna lose all your money. Don't trade. Don't mess with that." Those are all false things that always have kept us away from the market. So what we have to do is, like I said, play by the rules. Just like if sports, or just like with anything that we do in life, there's rules. So we have to play by the rules. If you break the rules, there's consequences. It's just that simple. So, but if you play by the rules, you can protect yourself, and you can protect your losses, and you can limit exactly what it is that you may put at risk for the trade. So, hey, it's an exciting time. It's a time that these conversations is what starts the change of everybody's life going forward, because it wakes you up to something that's been going on for many, 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 many years that we just haven't been a part of, but it's going on around us every day. You're seeing cars and people driving around you every day. And I know just like myself, you're looking and saying, damn, where's all these, nobody's working? What's going on? But it's a lot of people that's in the market, and they're making a very decent living part-time trading in the market, So let's just talk about some really good things that Delvin has on store for us. But I just want to say, hey, let's get excited about trading, because there's money, there's really money to be made.
Boy, well said, bro. Well said. Definitely well said. So that leads me right off to what I want to say. And I was thinking about just the week that just passed, and what happens in the stock market this week. Most of you, if not all of you, probably heard how there's been dips and big drops in the market and in the stock market most of the whole week. Record-breaking drops. Market's been falling, and I know you probably got some opinions or some feelings or concerns about, well, what does that mean? Well, how does that affect this? How does that affect that? So I wanted to kind of start out by talking about that, because like Eric just got through mentioning about the TV and the media and the things out there where, the conversations and what people be trying to tell you, things that kind of throw you off a little bit. What I mean by that is that here's what you're hearing. The stock market fell X amount of points. There was this huge record drop in the market, and it was $1 trillion lost, or 1.5 or 1.7 trillion dollars lost. So I want to stay right there for a second. When they say 1 trillion lost, 1.7 trillion lost in the stock market, see, when you're listening to this type of information, it makes you think everybody trading the stock market just lost their money. Everybody just lost. Everybody suffered or experienced a loss. But what we're coming here to tell you tonight is that that's incorrect information. Very incorrect information. And what do I mean by that? It was more so just like this word you've heard before, like a wealth transfer. That's basically what happened. And what do I mean? For example, let me explain. If you understand that everybody in the market, remember Jimmy talked about speculators. And what makes the market work is the speculators. Because speculators are either looking at the prices to go up or looking at the prices to go down. So when you see the market fall, however many points they fall, and they they tell you that the market lost $1 trillion, you're thinking everybody experienced a loss. Well, the people that experienced a loss are only the bulls, only those that were long the market. That's who experienced the loss, not the entire market. Because everybody in the market wasn't riding it to the upside, guys. So they put it out to make you think one thing, but it really is not explained and understood the correct way. Yeah, $1 trillion was lost, but where did it go? It didn't just go flying out in space. Some people were riding this market to the downside. Some people, what if I told you that a lot of people just made thousands of dollars last week in the stock market? Some people just made hundreds of thousands of dollars last week in the stock market. Some experienced millions during this drop last week that you think everybody lost their money. But everybody was not trading the stock market to the upside. Some people couldn't sleep, they were making so much money last week. And that's what I want you to understand. You gotta learn how this market really works. And you can't really learn how this market works listening to all the naysayers, all the gossip, the rumors, and a lot of stuff you hear on TV, because they don't give you the real juice and understanding on how this market works. So I just wanted to make sure we understood, just from a standpoint of what happened in the stock market. That was a big loss, but it was a big loss for those who were riding the market that direction. So just understand that money just transfers in the market. And this depends on what direction you're in the market going. So it doesn't, $1 trillion had to go to somebody. It didn't just drop. The market didn't just drop and then $1 trillion went to the moon. No, it was just a transfer. But they don't explain that part. Anything you want to add on that, Eric?
Before Eric adds, I want you to do the disclaimer, please, Delvin. Do our disclaimer.
Yeah, thank you for that. Yeah, you're right. I definitely need to stop, guys, and just give a disclaimer that we always need to make sure we do before we get started, and that trading commodities in the futures market involves risk, and that risk involved, and everybody needs to take and consider whether this is for you, and always understand that the risk, whatever you're risking in the market, needs to be risk capital that you can afford to risk. Okay, with that being said, Eric, you want to add, or you had anything you want to say on that?
Well, I mean, I'll definitely, just piggyback and say, what Delvin is saying is 100% correct. There's another side to the market. We only know or only really look at the market on going up. We buy something low and we sell it high. That's kind of the mentality that kind of what we've been taught. But there is another side of the market to be able to either short the market, or what we call on the other side for more affordable people, we call buying options, or what we call buying put options, which allows you to actually, take a guess, an educated guess when the market is going to go down. Because what we look for, what we're looking for is support and resistance on any particular trade that we have out there. Resistance, if you think about it, resistance is like the ceiling and the support is like the floor. And stocks, they have a hard time either going through the ceiling or through the floor. A lot of times they trade within what they call a channel. They'll trade, go up and they'll go down. So when you're looking at a stock, for instance, that's Tesla is an example. Tesla was a stock, where it was a company that if you bought into Tesla, some years ago, if you listened to a lot of the naysayers and didn't really delve into really paying attention to what the company was doing and looking at whether the company was actually growing quarter over quarter, it doesn't take a rocket scientist to look at a company and say, they made $5 million the first quarter, and second quarter they made $10 million, third quarter they made $20 million. It don't take a rocket scientist to see that company is maybe on an uptrend. So when you looking at it, and when you go in and decide if you want to actually go in that direction, for instance, with Tesla was a stock that went all the way up to $968 or whatever. And this is a company that they thought would fail. And nobody saw electric powered cars and different things and autonomous vehicles and nobody saw that years ago. Nobody thought you could actually make a company from that. But those niche people who bought into that situation right there, they're somewhere on a beach somewhere. They're living a great life just off of that one stock. So that's why it becomes so valuable to get into this market, because you can see one situation can change your entire life. It's somebody's entire life was changed when they purchased Tesla when it was a baby, and they kept it and held on to it, and they believed in Elon Musk and what he was doing over with the company, and they held on to it. The same thing with Apple or any other company, but when you're looking at it, you not only want to look at the company for the company going on the upside, you want to look at the fact that if a company has reached its highest potential, it's the highest it's been in the career of the company. If you're looking at it, that means that the company is at resistance. So it's time to start taking a look at the company and start to look at, is the company going flat? Is the company still growing quarter after quarter? If you see that the company is still growing quarter after quarter, you can pretty much make an educated guess that, hey, I'm going to continue to buy into this company and ride it to the upside. Or you can look at the company and say, they made $5 million the first quarter, $10 million the second quarter, and then they only made $10 million the third quarter, and then they turned around and they made $9 million the fourth quarter. That company is falling flat. So you can see it's coming down. It's coming down. So you can see that if it's at resistance, you can make a pretty much an educated guess and say, hey, I'm going to ride the company and buy and short the market and ride the company down because the company is not doing as well. If that's your educated guess, so you can see how you can look at the market on both ways. You don't just have to look at a company, only companies that's going up. You can look at companies that's great companies that's on their way down. And there's plenty of money to be made on companies that's on their way down. It's just as many companies going up as they are going down on a day-to-day basis. So it broadens your trading skills to be able to have more on your watch list, that more companies on your watch list that you're watching on a day-to-day basis, because you want to look at each individual company and you want to look at the chart and determine whether it's at its highest that it's ever been or it's at its lowest it's ever been, and then make an educated guess on by looking at the simple numbers. I mean, you don't have to be, like I say, you don't have to be a rocket scientist and really delve into the entire company's numbers. All you need to really look at is the revenue. And you can look at whether you believe in the company. A lot of products we consume, so if we consume in the products, that's saying that we obviously believe in the product. So we can really start there with companies from right in our own household on, when we jumping into the market. We don't really have to really jump, into nothing strange, but we can jump into things that we actually know and companies that we actually believe in. And we can buy those companies, whether they're on a potential of going up or whether they're on a potential that they've, done exhausted themselves and that they got too much debt on the books or whatever the case, and that they're on their way down. So when looking at a market, that these are great buying opportunities. Don't let no one fool you. When the market falls and corrects itself, these are great buying opportunities for you to be able to get these companies a lot of times on a bargain and be able to purchase these companies where they was, could have been a few dollars more or a lot more, prior to the market correcting. And the market is always correcting itself, especially on a major basis every 12 years or so. You can pretty much bet that, we're going to see a day like the last week that we had where stocks are kind of going to go down for a little bit. But like I said, it's not to be fearful of any stocks or any market going down. You just want to be on the right side of the market.
Exactly, man. Exactly. As you were talking, I can't help but just think about being on the right side and catching the market when you say a great buying opportunity, when something really drops tremendously and the market falls, and you can look at it the wrong way and say, oh man, prices don't fell all the way down, or you can see from a whole different angle and say, hey man, this is a great buying opportunity. And that takes me back to, man, when there was a situation that happened in the market that really would have changed our life. I don't know how our life would have turned out or where we would be at today from this particular situation that we had caught. We ended up catching a trade in the sugar market. And this sugar, guys, I want to just explain to you that sugar hit a price that it has never hit since we've been trading, but one time. And we was in it. So when he was talking about support and resistance, the ceiling and the floor, sugar went all the way down to the floor and we got in it. Me, Eric, Jimmy, I can't remember if Pam got in it or not, but we was in it from the bottom, from the floor that he was just talking about. And this experience could have, I'm talking about the way that we had a business plan mapped out to trade this market. We took and spent so many hours planning and putting our plan together to maximize how we were going to take advantage of this trade, because we was in a situation that had never happened in a long time and may not happen again. And it still hasn't happened since we've been trading. But that one time that we were in the sugar market. And I know you remember that, Eric, because that's one of the trades that we, man, I'm gonna be quiet and let you speak.
Sound like you're playing both ends against the middle.
Oh my goodness. Woo!
That was a very, that was a very, very, it took a lot. I mean, we did have a plan, and the guy who we actually learned how to start trading from, he actually built his fortune off of the sugar market. He caught the sugar market 40 years prior to that at his lows, which was actually around $6. So when we caught it, it was actually $3 lower than when Ken Roberts actually caught the sugar market and made his millions. So when me and Delvin and us came up with the plan, I mean, we actually had it written down where, I mean, we just knew we was going to make millions, I mean, off of this trade. I mean, literally, I mean, we were dancing every single day. I mean, it was a happy time to just watch the contracts continuously purchase themselves. Because when you're in the futures market, if a futures cost, say, $700, so as you build in profit, if you build enough profit up to $700, you could purchase another contract. So every time the profit takes you up to $700, you purchase another contract. So we were building contracts, and it was just such a happy time. But unfortunately, it all came crashing down because we didn't finish our studies. We thought that we had arrived to a place that we really wasn't there yet. And when we, woke up one morning, sugar wasn't going in a direction that we were wanting it to go. And one of the biggest mistakes, and I'm gonna pause right here and say this, one of the biggest mistakes that you can make when you trade is to not protect yourself with what they call a stop loss. A stop loss limits your losses and takes you out of the market to keep you from losing it all. We forgot, we didn't study that part, or we looked over that part and took it for granted. Whatever we did, we traded, it wasn't the right way. We traded, and we was trading without a stop in place, a stop loss in place, and the market messed around and it turned around and it went a different direction. So it took a lot, of profit, pretty much all of our profit, except a few $1,000s off of the table. And literally, I mean, it sent me into a depression. I mean, I kind of like, I didn't want to trade no more. I was done. I mean, I kind of walked away from it for a minute. I was just that hurt, that the market did that. But it took me years to really realize that it wasn't the market. It was me. I mean, I needed to study more, and I needed to understand how to protect myself better in the market, So once I got back into the market and started trading again, I took and just like I started off saying, I started playing by the rules. Like I said, the moment you start going against the rules, I mean, that's like things just go all different kind of ways. That's why you got to stay within the rules. And if we had just stayed within the rules and protected ourselves, we could be sitting on this phone call with a totally different conversation, but I don't count it as all bad, because it really taught us a valuable lesson for the rest of our life, to not risk money without protecting it at the same time. So now when we put the orders in, we put an order in, but we also put the stop in, so we know exactly what we got risk on the table. And so, that was a very great example, Delvin. It was something that really taught us that this is truly a business, and that if you, like I said, if you treat it that way, if you're careful with it, not that you won't have any losses, but you'll have more wins than losses. And that's what trading is all about. It's not about never, having any losses. It's about having more wins than losses. So, that's really, at the end of the day, where it boils down to. So, hey, great story, Delvin. We learned a lot from it. It's made us better traders, at the end of the day, but, I'll definitely say, when you get into the market, make sure that we really learn that portion of protecting what it is that you're putting out there for risk.
Yeah, it's almost like we had an opportunity to learn something that now we can help people from making the same mistakes that we made. When you think about the tens of thousands of dollars we had risk on the market and gave back, that we were making daily. It was ridiculous. See, when you go back and look at those statements, I remember you was sharing, man, you still got the paper statements from those trades. And I can't even look at those statements because the money that we were making, and when you talk about protecting yourself and making huge mistakes, it makes you really realize that it was our ego, man. It was our ego, because there was no reason. It wasn't that we didn't know to trail with a stop loss, because we had done it in other trades. But when we saw this one, we didn't want the stop loss to take us out the market. That's what happened. We know that was going to take us out, and we didn't want that to happen. So we wanted to have enough cushion, and we gave it all the cushion to keep us in the market, and it took us out of the market and took the profit back. And now we can show and keep everybody from making that same mistake. So that was the lesson in there, like you said. That was the lesson in that, man. But I know we'll never forget it. But the thing is, so you guys need to understand what we're talking about. Opportunities like this happen in the commodities market. This is something that excites me all the time. The fact that these stories and these opportunities happen every year. You just got to be watching and looking for them. This was a sugar market, but it can be in something else. These opportunities happen all the time. And once you learn the skill of learning how to trade, you'll be able to spot these opportunities and take advantage of them. You hear me talk about the grains all the time because that's my favorite market. I just gravitated to that. That's all I'm normally looking for. And I wanted to get into that too tonight. As well, what I want you guys to try to do as some homework, but we'll get to that in a minute. But yeah, that just really something I just wanted to go over. But let's take some notes for a minute, guys, for a few minutes. So as we talk about the commodities and futures market, I want you guys to know and understand what exchanges that these commodities and futures are traded on. So jot down the CBOT. CBOT, and that stands for the Chicago Board of Trade. That's where a lot of your commodities are traded at. That's where the grains are traded at. That's where a lot of options are traded at on commodities. Also, I want you to write down the CME exchange. That stands for the Chicago Mercantile Exchange. That's where a lot of commodities and futures are traded at as well. That's where the meats are traded, and another market where a lot of options on commodities are traded at. Over in New York, you got the COMEX, and that's where the metals are trading at. COMEX. That's where the sauce, the food. So you have the orange juice and the coffee, cocoa, and then you have the precious metals being traded over there. Some of your currencies will be traded. So these are exchanges where a lot of the commodities and the futures are traded at. And you don't have to have an account on these exchanges. I just want you guys to know where the markets are, where are these trading at. So this is where they trade at. But the Ameritrade account that you guys are opening, that's where your account will be. And that I was gonna make sure we did cover options, Eric, because I do want to make sure people have that opportunity to know that we are going to teach them how to trade options, because everybody may not have the tolerance or may not want to trade the futures contract. And everybody needs to have the opportunity to be able to take advantage of all options that are available to them, with the options being an opportunity that basically, in a simple way of putting things, what are options? If I had to just break a word out that would help you understand it without trying to explain it all over your head, I would just say insurance policy. That's basically where options are. They are insurance policy. You hear Miss Mason sometimes, if you've been on some of her trainings, you hear her always saying about having some skin in the game. That's what options are. It allows you to have some skin in the game. You may not have the funds, or you may not have the tolerance to trade the futures contract on that particular one because you've been paper trading it and you see, man, that market moves too volatile for me. But I was looking at the options and I found an option, a call option or a put option for $100. I'm gonna trade the option instead of the futures contract. So that's something that we're gonna also get into, because we've traded that for years and made lots of money trading options. So you hear me keep talking about the futures contract, but I haven't really kind of got into the fact that I want to introduce and show y'all how to trade the options as well. I know you like the options too, Eric.
Yeah. Options. I mean, like I said, options. I mean, it's an affordable way to get into the market. A more affordable way. Like I said, some of us got the money to purchase. Whether it's commodities or whether it's stocks. I mean, it's a derivative of that stock, or that future that you got the option in. So, for instance, if I was to purchase 100 shares of, let's say, Apple, or whatever the case may be. I'm not sure what that is. If I was to purchase 100 shares of Apple, and Apple's trading at $300, I mean, that's you can do the math, and I mean that's a lot of money to try to purchase 100 shares of a company like that. But if with options allow you to purchase those same 100 shares, but for a fraction of the cost. And like Delvin said, it's like an insurance policy, because options build premium. They build premium and they lose premium. So when you looking at options, and no matter whether commodities or stocks, what you're buying is a lot of time is time. You know, I mean, we hear all the time is money. This is truly an instance where time is money, you know, because when you purchase an option, you want to purchase an option that gives you enough time to do what it is that you want that option to do. So if you want the market to go up, you know, you want to give whatever that commodity or that stock time for it to go in the direction that it needs to go. When you purchase you know, those are one of the criteria when you purchase an option, is looking at how much time do I have before this option expires, because just like with insurance, it's like an insurance policy, they expire. It's like Delvin said, that it works almost identical to an insurance policy, the way that it expires and the way that it lose premium and gain premium. So that's just one of the mindful things from, you know, options. I love options because, like I said, it for me, it's just a more affordable way to deal with the market, versus putting out, you know, what I call big boy money, you know, because that's what it takes to play in the real stock game or the real futures market. You know, it can get expensive, you know, depending on the commodity or the stock that you choose. So that's, you know, that's I would say, and even I'll say another thing, even with it's something on everybody's budget. Even with commodity, they have what they call mini contracts. So the mini contracts allow you to, you know, even spend less money on trying to get into the market. So they have it's a way for everybody to entertain the market, you know, on whatever the budget is that you may have to start. But the key is just repetitious. I mean, the more you put in an order, the more you say the terminology, the more you look at a ticker symbol, you know, the more you view it, the less intimidating it becomes, you know, and the more you calling in, or if you calling in through a broker, you know, the more you calling in order to buy something or to sell something or whatever, the more you call those orders in, the more familiar you become with it, and it becomes pretty much second nature to what it is that you what order that you're putting in. Just keep in mind that, you know, whether you trade options or whether you trade futures or whether you trade the stocks, you know, just make sure that your risk capital is always in line with your account, you know. And like I said, I can't stress enough to make sure that you discipline enough to keep that 10%, you know, in play, and that will protect you from a lot of heartache, you know, in the future.
Yeah, Eric, I love the fact that you keep reiterating that risk management, because that's something we didn't know and didn't have in the beginning. We learned that later on, you know, what they call risk management, and that's learning how to manage your account. So that goes back to what he was talking about making sure that you come into this whole entire trading platform with the mindset of that you're running a business. So when you're running a business, you're gonna make sure you're not gonna be just out here losing money. You know, because how can you make a profit if you continuously losing money? So risk management is one of the most important things. Leverage and compound and risk management and controlling your emotions, I think those are the most important things when it comes to trading. You can make bad decisions, and I would say patience too. But you can make a lot of bad decisions from doing those things I just mentioned wrong. So when you were just talking about the order, if you don't mind, man, let's go into just actually through the process of placing the order. Let's walk through that process of placing the order, whether it be shared on stocks, options, or futures, whichever one you want to do. But let's just go through the process of placing the order, whether it be online or calling in with the broker.
Okay. I trade online. I trade online, and putting in the orders are pretty simple. When you go on the platform on the Ameritrade, is that what everybody has, the Ameritrade?
For the most part, we got a few people that gonna have to figure out different. We got to figure out a different platform for some of the people that's in the Bahamas because Ameritrade doesn't allow them to use that platform. But everybody else, and I think Margaret has a Charles Schwab, but mostly everybody's trying to get on with. And Jimmy's supposed to be working with everybody, helping get the account open.
Okay, I mean the Charles Schwab. I mean most of the platforms are pretty similar, you know, as how they work. You know, I mean it's a very, I mean it's so easy. I mean it's a trade button that's on there, and if you're buying stocks or whatever online, when you click the trade button and put the ticker symbol in, because every company has what they call a ticker symbol, and that they go by that identifies the, you know, that company with that ticker symbol. So when you put the ticker symbol in the box and pull up the company that you're looking for, you're simply, it's two buttons. I mean, it's a buy and sell button that's on there. You know, if you're thinking that the pricing or whatever is going to go up, you know, you're buying, you're long, what they call long the market. You know, you're going long, you're going out there because you think the stock is going to go up. But if you think the stock is going to go down, or, you know, you can short, what they call buy a put option. I wouldn't say short the market. Shorting the market is for a very experienced person. There's a big difference between shorting the market and buying a put option. What we want to do as the not the big boys, we want to buy put options. You know, we don't want to short the market. Short the market is just is very expensive to, you know, to short the market. So I want to make sure I'm clear that we're not shorting the market. When we're thinking prices are going to go down, we're buying put options to drive or to ride the market down. So but when you click on the trade button and you put your ticker symbol in there, you pull up the company that you want, you buy, you click on buy, how many shares that you want to buy. I think it asks you, the question, do you want a limit order? Do you want a market order? Or, you know, different questions like that. You always want to do a limit order. You know, I always do a limit order. The reason being is I want the price to come to where I want it to come to. You know, I don't, you know, market orders can be very tricky. You know what I mean? When you just say, I'm just going to buy at the market, you're just depending on a broker to just buy in wherever the market is. And that sometimes can be good, sometimes it can be bad. So I say put in what we call a limit order, and you can dictate the price that you want right there on the screen. So if you want to buy it at $7, you put in $7 and you click buy, and you sit and wait for your phone to buzz or for you to get a notification that you've been filled at $7. If you don't get filled at the $7, that means that it never reached the $7 or whatever. So it will cancel itself out at the end of that trade day. So the next day, you have to go back in and put that order back in again that morning to try to get and hope that you can get it for the price that you want to get it for, providing that the company doesn't open up higher than where you're trying to pay for the stock at, you know, or the commodity at. So, you know, but at the same time, you know, just be very mindful that options is, you know, to me, in trading on the platform, you know, it can be tricky, but the more you play with it, the easier it becomes on the online platform. Now, when you call in a broker, you know, I know Delvin likes he still likes to call in and have hands-on with his broker, which there is no right or wrong way to do it. I mean, to build a relationship with the broker is a great thing. I mean, you know, they tell you a lot, they teach you a lot. You know, a lot of times they keep you from going into holes that, you know, in areas that you really don't want to go in. So to be able to have that person in the beginning to be able to talk to is a wonderful thing until you kind of get the hang of it and you can go onto a platform and purchase the stocks or the commodities that you want to purchase right there on the platform. But But once you place your order and click your buy, you're just simply gonna, like I said, you simply will wait for a notification to say that you were filled and you are now the proud owner of Apple stock, or you are now the proud owner of one contract of lumber or one contract of gold or silver, whatever it is that you're buying.
Okay. Also, now make sure we got a clear understanding on those two words he mentioned about market order and limit order.
Mm-hmm.
So a market order is basically when you place an order to buy at the current price that market is trading at.
Mm-hmm.
You just buying it right there. You ain't trying to place an order to catch it at a certain price or to get in at $7. Like $7 might have been your price, but then you just decided I'm just gonna go in at the price that it's trading at right now. That's a market order. And a limit order is something that you've always heard me say, that I like to let the market come to me. Like Derek just said, it's when you place an order to get filled at the price that you want to be filled at. And sometimes the market may not never reach that price, like Eric said. Sometimes the market will save you from losing money. That might not even been a good trade, and you've been like, you was mad that you didn't get filled sometimes, but then it turned out it was a great thing because you was wrong about that trade. So the limit order basically allows you to have a plan, execute the plan, and let the market come to you if that plan working, and it won't come to you if it's not working. So that's the difference between what you call a limit order and a market order. So I guess, man, we want to take some questions, see if we got any questions. If we got any questions in the chat, Tracy?
No, there are no questions in the chat.
Well, open up the line. If anybody got any question, anything you want to say or add or ask.
Devin,
Yes, sir.
I logged into my Ameritrade account because I remember last week, who was it?
Or
No, someone, it was a lady, Vanessa, I believe it was, said that you could go on, log into your account and, in order to find out something about paper trade. Because this is where we really need to start at, right? We don't really need to try to learn all these other strategies and things right now, do we? I mean, that might be helpful in paper trading. I don't know, but is it true that we really need to kind of get a paper trading, set up? Because what I was getting at is I Googled it. Well, I searched it in my Ameritrade account, like she said, and these are the things that popped up. Like, how do I sign up for paper trading confirmation? And one of them said, and another one said, request paper statement. Let Ted show you how to request paper statement. So I haven't clicked on any of them, but I was just wondering, are we going to get to that point when we need to start paper trading, or we still need to learn some more facts and terminology and strategies like we kind of going over?
Yeah, we needed to get you to understand everything, because if we just jumped into paper trading, a lot of this stuff that we talking about, like the stuff we saying tonight, then we will have to keep stopping trying to explain it, because you wouldn't understand how to place an order, or what does that mean? What is that? So we need to make sure we understand the language and how to do the things, and then we jump into the paper trading, because paper trading is where everybody needs to start at. That's the way we started. That's the way what's recommended, and that's really what's going to allow you guys all to be able to have an account with Ameritrade. The fact that we're going to go through some paper trading, and you will be able to say that you do have experience, because they won't give you an account to start trading futures if you went on there and answered the question and said you don't have any experience. So we gotta get you through some paper trading, get you familiar with how these markets work, and how the markets move before you get in there with real money, because that'd be like suicide if we just dived in with real money without paper trading. So paper trading is what's coming up. we getting close to getting started with that. So everybody who got the Ameritrade account, we need to get everybody to a point where they got an account, and then get everybody set up for paper trading, because we're gonna be getting started with that. But we just needed to make sure you understood the lingo and the whole language of how trading works before we got into the paper trade. Because all this stuff we talking about, we're gonna do it in the paper trading. We're just not gonna be using real money. We're gonna just be doing it with paper, on paper. Anybody you want to add to that, Eric?
Okay, we are starting to get questions, so just to let you know that to come back to me.
Okay, Eric, did you want to add to that, or could we move on to the next question?
No. I mean, what you're saying is 100% correct. I mean, you definitely have to start. We have to build. I mean, you have to build a foundation. Paper trading is when you're ready to start. I mean, you're ready. You feel like you got the information and you're ready to put yourself out there, but you're just not putting no risk capital out there yet. So but understanding some of the basic lingo, like Delvin said, I mean, it would just help you to paper trade a little bit better. That's all.
Can I add something quickly?
Hey, Margaret.
Hi there. My suggestion too, if you already have your account set up with Ameritrade or whatever platform you're on, check the educational part of that, because most of them have an educational link there. And that way you can at least start trying to understand some of the lingo, there. And also, if we don't gonna be paper trading, when I started options, we always had anything, stock, whatever I was trading. Because I learned with getting a trading plan, having a plan, and so you're gonna have on that plan how where you're going in at, where you put your stops at, and all that. So, but anyway, do look at the educational part on that whatever platform you're on, and just kind of get yourself familiar with the language.
Yeah, you're right, Margaret. I do see the educational link at the top of the page there on my account.
Great point, Margaret. Any more questions you got?
Are you ready for the next question?
Yes.
So basically, what everybody was saying is do your research before you jump into anything. So the next question is from Sandra Williams. What does COEX mean?
COX that's an exchange, and those are just initials for what that actual market. I forgot what the actual word, all the words actually come out to, but it's just a abbreviation of what that exchange name is, and that's where the precious metals like gold is traded at in New York on the COMEX exchange. But it actually has a whole entire name. Like when I said CBOT, that stands for Chicago Board of Trade. Well, COMEX stands for something too. I just forgot the whole entire word, but it's just an exchange in New York where a lot of trades take place.
Hey, Delvin, I have a question to ask about those exchanges. Are there three main ones? It's the Chicago, the New York, and there's another one, right?
The COMEX that she was just mentioning, that's where most of the futures are traded at. But there's other trade exchanges, but I was giving you the ones where most of the futures are traded at. Just about all the futures that we would go over are traded on one of those three exchanges. Okay. Keep in mind, guys, every time you hear me say futures or commodities, I'm referring to the same thing. They refer to either one, both of them are referring to the same market. But that's what they will be: Chicago Board of Trade, Chicago Mercantile Exchange, or the COMEX exchange.
Okay, Delvin, while we're still on that COMEX, I Googled it and it said this COMEX is CME Group, but it says CME Group is the world's leading and most diverse derivatives marketplace made up of 4 exchanges: CME, CBOT, NY, MEX, and COMEX. Each exchange, these are exchanges. COMEX is a part of these exchanges. Metal products. I mean, they talked about copper and well, you know, the different metal product that you mentioned when you was talking about that group. So that was just some information. I just Googled it and it came up. But listen to this though. It says COMEX is the primary futures and options market for trading metals such as gold, silver, copper, and aluminum, formerly known as the Commodity Exchange. COMEX merged with the New York Mercantile Exchange, that's NYMEX, and until a year. So that's just some more information about that exchange that I'm.
Yeah, that's what like I said, that's where the metals are traded at.
Right.
Great information.
Also, I don't want people to be confused that when you're trading on your exchange, the exchange that you have signed up for, like Ameritrade. So you'll trade futures, options, and whatever on that platform. So I just don't want them to be confused that they might have to go to the Chicago exchange or the CME, the CBOT. But you'll be trading on your Ameritrade account.
Can you have more than one exchange? Can you trade on more than one if you want to?
Well, all these are traded on different exchanges. So you whenever you're trading, whatever it is you're trading, if you're trading gold, it's going to be traded on the New York exchange. If you're trading corn, it's going to be traded on the Chicago Board of Trade. Wherever it's traded at, that's where it's going to trade at. But yeah, great point, Margaret. I did mention earlier when I was saying it that you don't need an account on these exchanges, but I wanted y'all to know what the commodities, what the futures were traded at. But you open up an account, that account allows you to be able to trade any of these commodities or any of these stocks, any of these options, no matter where they're traded at.
All right. Tracy?
All right, next question is from Vanessa. Can you explain put options?
Okay, you want me to explain that one, Eric, or you want to?
Yeah, I mean, put options is simply, the right, but not the obligation to basically purchase an underlying stock or commodity when you anticipate pricing going down.
Can I give an example of that? Can I give an example of put?
Yes.
Go ahead, Mark.
Everybody remember 9/11, right? Everybody remember 9/11?
Right.
When those planes went into those buildings, they said there were so many put options on those that airline that multiple millions of dollars were made. So the stock went down so fast that the stock market, they had to stop those options. That's how much money was being made. So it was going down, and millions of dollars were made during that time. That they stopped the stock market.
Delvin, can I add to that too?
Also, Vanessa, just to make sure you understand, when we're talking about options, options are another way to trade the market, just like futures contracts, just like shares in the stock market. And when you're trading with options, remember the word put and remember the word call. They're just opposites of each other. And you can also write down the word spread, because we'll get into explaining what a spread is when you're talking about options. But call is just the same thing when we were talking about a direction of a market being up and down, put being the same thing when you talk about a market being up and down. Those are the words when you're using options.
Delvin, can I add to that if that's okay?
Oh, sure. Go ahead, Ori.
This is Orion. I just wanted to say, those who are on our commodities channel on Telegram, that second video goes into that as well. Call options and put options, just in case you're curious more about that.
Okay.
That was part of our homework.
Okay, that's the second video that you posted in the Telegram group. Okay,
Uh-huh.
appreciate that.
So Orion, I would just like to say thank you so much for what you do in Telegram, but I also want to ask, are you clicking on it? Are you reading it? Are you using it? Or is this, you know, what you want? You know, I'm not trying to check anybody, but it's a lot of information already there that would take what, 20 minutes, 30 minutes to look at?
Mm-hmm.
Just saying.
Yeah.
Tracy, any more questions?
Yes, from Sandra. I'm gonna have Sandra unmute and ask your question verbally.
Okay, thank you. I wanted to ask, what about trading currencies?
Okay, guys, so there's different categories within the futures market, within the commodities market. And the meats, the grains, the metals are what you keep hearing us refer to, but there are other markets like the food, the energies, the financials, and then the currencies that she's referring to. So you have all these that are traded within the futures commodities market. So if you go back to the website that you heard me and Jimmy refer to, barchart.com, when you went through that selection to look at the different categories where you were moving around, when we went there to go look at the profile for the gold that time, to look at the points, I don't know if you were on that call, Sandra, or not.
I don't think I was. That was the first one, wasn't it?
Okay.
The first call.
So,
What's the website again?
barchart.com.
Bar chart? I'm sorry.
Yes. So
Okay.
currencies are definitely in the futures market. You can trade them all, from basically everyone you can think of, from the US dollar, Japanese yen, British pound, Canadian dollar. They're all being traded. Even Bitcoin is traded in the futures market on the currencies.
Okay,
So,
awesome.
so yeah, they're there for you to all look at, keep watching, just like the other markets. You just haven't heard me referring to them that much or at all, but yeah, they're traded in the futures market.
Okay, thank you, Delvin.
You're welcome.
And I'm gonna say also, the currency market is I mean, that's probably the largest market. That's the most liquid market. You know, they have a separate. I mean, it's a separate one called. I'm not everybody familiar with the forex market, but the forex market is specifically just the currencies. If you know, it's a totally different. It's a little bit different than trading commodities or stocks, you know, but it's just focused just on currency. That's how big the currency market is. I mean, it's the most liquidity out of all of the markets.
Exactly. And the currencies, like you said, that's what in the forex market, that's where they trade the currencies. They trade gold and a couple of US 30, but mostly currency, all currencies in the forex market. And basically, guys, what the forex is basically a market that came about because if you go back and if you remember back in 1971, when President Nixon took us off the gold standard, basically what that did was it took the whole world off the gold standard, and it made all currencies just lose their backing and become like a fluctuation going on in the market where none of these currencies had any stability anymore. And basically what that did was that introduced the forex market, because now these currencies were trading against each other because they had no stability when they were all pegged to the dollar. But now here we needed the forex market to kind of try to balance it out because they all came like they was all in the ring fighting against each other when they were all riding on the same wave when they were under the gold standard. But that's how the forex market came about. But that's all about currency. So yeah, currencies we can trade in the futures market. So if that's something that you want to look at or you're interested in, this is the platform where they started at in the futures and commodities market. Like Eric said, that's the biggest market within the futures commodities is the currencies.
And we all participate with the currency market, you know, if you've traveled out of the country or anything like that and had to convert money over, I mean, you participated in the currency market, because if you bought Jamaican dollars, and then, you know, sometimes you can, you know, if you ever notice or if anybody ever experienced, you go and trade your money back in, you actually made a couple dollars, you know, that you actually, when you went to convert the money back over. But it just basically teams each country up with another, you know, with another country, and it's basically a currency against currency. And like Delvin said, the currencies are just constantly rising and dropping every single day, all day long. You know, they're being devalued and valued all day long. So it's a very volatile market, which makes it there's a lot of great opportunities in the forex market to make money because it's a market that really trades almost 24 hours a day, I believe. The forex trades, you know, 24 hours a day, so you can trade all day with the forex. But it's a different type of a market than the basic commodities or the stocks.
Yes, Eric, when you were explaining about in the beginning with you and Delvin and how you didn't have the stop limit.
Mm-hmm.
Well, on the currency side, I did with Forex, and, you know, I really enjoyed the scalping part, but I learned my lesson. my stop limits there.
Yes. It only takes one time to learn that lesson.
Yes, so I'm here to learn the skill set.
Awesome.
Let me ask you something about that your stop limit, and how it affects your account. Say, for instance, you got in your account, your balance is, let's just say 1,000, but then you buy a contract or whatever, futures contract or option. I don't know which one is relevant, but you buy a contract for, let's say $100 then, okay? And then I heard you mention something about the 10% rule. So now, say, okay, so I'm just trying to understand how that stop, how you would place it. You know, how would you place a stop order? You know, for example.
For an example, okay. Say for an example, we were looking to purchase a stock, say for $5. It cost $5 a share for us to purchase the stock.
Mm-hmm.
You know, we wanted to purchase with $5. We wanted to purchase 20 shares. We wanted to spend $100. We wanted to purchase 20 shares. You know, the stock was $5. The stop loss goes in to where you're risking that $5, but you may not want to risk that whole $5. So you would put a stop in somewhere around. You may feel comfortable at $4.50. You may feel comfortable at $4.25. But what that stop does is it allows you to not lose less than the $4.25 or less than the $4.50 wherever you put the stop at. So you're just basically putting that risk on the table. So when you go and put your stop in, that's your insurance policy that, hey, you know, if this market go in the opposite direction of where I was wanting it to go, I won't lose all of my money. I will just lose a portion of my money.
Right. And on top of that, say if you didn't put the stop at the $5 or the $4.50, and it kept dropping, so then it would go. Then they would start like a bank when you overdraw your account?
No, you would just lose that. You would just lose. I mean, you would just, if the stock goes to zero. I mean, or stock trade, you will lose that $100.
Okay,
That's
just
the
that.
most. That's the most that you're going to lose. So whenever you purchase options, the most you're going to lose is what you paid for that option. That's why, there again, it becomes a more affordable way. Now, if you own the actual stock, and say you own Apple stock at $300, and you purchased it at $300, and it started going backwards down to 200 and 100. I mean, it can go all the way down. It can keep going. I mean, your losses can mount. I mean, it can really mount pretty big because you own the stock.
Right. Okay. That's right.
And I want to give you an example. Eric gave you an example from the stock market. Now I want to give you the same example, but I want to give you an example from the commodities futures market. And I want you to write this down.
Okay.
But we're gonna go through an actual trade. Okay. So I'm gonna use corn, my favorite commodity. So I told you guys once before, so let me say it again in case somebody wasn't on that call. In the corn business, in the corn market, every cent that corn moves equals $50. That doesn't matter. It doesn't matter if it goes in your favor or against you. It's $50, up or down. Okay. So we're gonna go through an example so you can understand the stop loss. We buying corn at $3.50. We put in that limit order to buy corn at $3.50. Okay. In your example, Mr. Mason, we had $1,000 in our account.
Mm-hmm.
We look and see what's the margin. The margin is basically like a deposit to control that corn contract. Every contract in corn controls 5,000 bushels of corn.
Okay.
But that's the leverage that you have in the market where you actually can come in with a margin of $400 and control that contract. That's 5,000 bushels that would have cost you way more than that if it weren't for the leverage that we have in the market. So you look up the margin and it's $400 to control that contract. So when you get filled on that order, that $400 from your account allowed you to purchase this contract. So it's not available for you to get into any other trade because it's pretty much obligated to this trade. Now, based on the 10% rule Eric was explaining to you, you got filled at $350. And if you're only gonna risk 10% of your account on this trade, 10% of $1,000 would be $100. So that means that you only want to risk $100 on this corn trade. You got filled at $3.50. I told you every cent equals $50. So if we were placing a stop loss, we want the stop loss to be at $3.48 because that would be 2 cents below the price that we got filled at. And every cent, so from $3 to $3.49 is $50. $3.48 is $50. There's our $100 that we're risking on the trade. So we got filled at $3.50. If the market drops down to $3.48, your stop loss is in place and your order would sell, getting you out of that trade because that's all you had risk on the trade. So you didn't risk the whole $400 that it cost you to control the contract. You only risked 100 of it because of where you put your stop loss.
Mm-hmm. You said every cent is worth $50. Did you say?
That's right. So if you got filled at $3.50, and then corn went down to $3.49, you're down $50.
Right, right.
If it went down to $3.48, you're down $100. That's where your stop loss is. So now your order just got sold. You just got filled on a sell order And now you're out of that market at 348. You lost $100 because that's all you was risking on the trade. You didn't risk the whole 400.
Okay.
400, you will move the stop down a lot lower. Make sense?
It makes sense, but the only thing I don't understand is the 350 that you started at.
That's the price that the market's trading at where you place your order to get filled. We use that example.
Okay.
Looking at corn, we've been doing our due diligence. We're looking at corn and we say, well, I want to get in at $3.50 that's what I used in this example.
Okay.
So you got filled at $3.50. That's what corn is trading at.
Oh, so you see what corn is trading at? You know, if you're interested in corn, I'm just saying.
It could be trading at 348 at the time
Right.
you place the order.
Okay, so that's okay.
That's where you place that limit order to get filled. I want to buy it at 350.
Right.
That's what order I'm placing, and I'm going to bed. I put my order in. I want to buy it at 350. I'm only risking $100. I want my stop loss at 348. I see what happens when I wake up in the morning, because these markets trade overnight too. So you place the order at 350. Let's say you got filled before you went to bed. Most of the time, the way these markets move, you're gonna get filled before you even change the screen. That's how fast it is. That's how liquid these markets are in the futures market. But you just got filled at 350. That's where you wanted to buy it at. That order got filled, 350. Now you in. If it goes up to $3.51, you just made $50.
Okay.
If it goes down to 349, you just went down. You lost $50.
Just lost 50.
You don't want it to hit 348 because that's where you place the stop loss at.
Uh-huh.
So let's say the market start going in your favor then, okay? Just show you, let's go into how you will actually take advantage and use that stop loss to your advantage. You got filled at $3.50 and the market went up to $3.53.
Right.
What's your gain? What's your profit at that point? Can anybody tell me?
53, that's $150?
That's right. That's right. Each cent equals $50.
Right.
So you up $150. Okay?
Right.
But right now at this time, because of the 10% rule Eric just mentioned, now you're risking more than 10%.
So you want to snatch some of that out.
So
that's,
you can leave the stop at 348, or you can do the better thing and move the stop up.
Raise it up.
If you moved it up to 350, let's say you moved it up to $3.50 where you bought the coin at, right? That's break even for you. If it came back down to 350, you didn't make nothing, you didn't lose nothing.
You didn't lose nothing.
But say you put it up to 351, so you could take advantage of locking in $50 of that profit. Because if the market came back down from 353 and hit $3.51, now you stopped out at $3.51 instead of $3.48 because you moved the stop loss up.
Right.
That's what we call trailing the market, which we trail our trade with our profits.
Right.
We can lock in profits. So that goes that whole myth and all that stuff Eric was talking about, of how everybody telling you, they scare you to get into these markets, so you thinking you can lose everything. But there's a way to limit what you can lose if you learn how to trade the market properly.
Okay, now one other question, Deb. It's still on the same thing. You said a margin, your margin, okay, so coin, you had to put up $400, just for an example, right?
Right.
You got to put up $400 if you get into that coin market, right?
Right.
Right?
Right.
And then you look at what coin is trading for, whatever it's trading for, but you gave the example, it might be trading for 350 that day, whatever. Okay, then you put your stop order in there, how much you willing to lose and whatnot. Okay, and then you watch it and then you trail it. If it started going up, you trail it and you move your limit up. You kind of trail it somewhere, right?
And you will learn how to move that stop loss when we start paper trading. That's why
Okay.
we going through all the stuff that you need to learn first. But
Mhm.
there's a method and there's a skill to learning when to move the stop loss and where to move it to.
Oh.
All that's part of learning how to trade first before
Mhm.
we get in and learn how, and get familiar with these markets. That's why we're not playing with real money right now. So
Gotcha.
the stop
Okay.
loss, the stop loss can limit what you lose, and it can help you protect what you're making as you
Mhm.
in the trade.
Understand it. I
You want to add
understand.
anything, Eric?
No, I mean that's perfect. I mean, you explain that. You explain that perfect.
So Delvin, what I hear you saying is, it's no get rich quick.
Mhm.
You got to put some time in. It's a business. You've got to do your research and your homework and be patient. It's sort of like day trading, right? You got to sit there and until you're comfortable with it. So
Well,
if
that's if you want to be a day trader. You don't have to sit there. Remember I just said about going to bed.
right,
What's not recommended is to sit in front of the market and watch every tick. That's not recommended. But if you choose to, that's your right to do that. But it's not recommended. You don't have to watch the market. That's why we put a plan together and we put our plan in place and we go on with our life. And we can check back in. That's the purpose of being able to put in that limit order, put in that stop order. So you've done what the plan told you to do. You don't have to sit there and watch it. You will get filled if your plan worked. You may not get filled at all. The coin was trading at 346 and you
Mhm.
put that limit order to buy it at 350. There's no guarantee that it's going to trade up and hit 350.
Right.
So your order may not get filled, but that's where you put it at because that's what the plan, that's what the market, that's what, when you looked at the chart, when you went over whatever made you decide to buy that coin, we'll let you place that order for whatever price you place it at. But it don't mean that that's going to get filled. But if it does get filled, you have a stop loss order that's going to get filled if the market goes against you.
Delvin, just to pick up on that last question that was asked that you answered, in that example, can you put in multiple orders back to back where if the price does go up, then you can trail it too with the third order? Or is it just in pairs where you put in a stop loss order and then once it either executes or it goes up and you make a profit, can you put in a stop loss order and whatever you need to do to trail it as well?
Absolutely, you can. You can put these stop loss orders in at several different prices based on where your target for this trade. Say you've looked at this trade and you feel that coin could go to $3.70, and you know exactly how you want to trade it. So when you heard us talk about leverage, and Eric talk about the contracts, and you heard Jimmy talk about in futures, in commodities, money is not really what makes money. Contracts do. You can place an order to buy coin at $3.50, put a stop in at $3.48. Then you also can place an order after you determine, well, how much coin has to move for me to make another $400, and now I got profits that allow me to buy a second contract. Well, $400, every cent is $50. That would be 8 cents. That means when coin go from $3.50 to $3.58, I made $400, and my profits allow me to buy a second contract. So now, when I place that order, I can also place an order to buy a second one at $3.58. I can also place the order to put another sales stop loss at whatever price I want to put that at as well.
Mhm.
But that's something that you don't do in the beginning. You learn that skill.
Wouldn't that be a spread? Learning spreads, wouldn't that be a spread?
No, that was what we call pillaring in the futures market.
I mean, in
There's
the
a term
option,
called pillaring, and there's a term called pyramiding.
yeah, it's not in the options market, that's not a spread.
There could be a spread in the option market. Yeah, it could be. In the futures market, that will be pillaring and pyramiding is what we call it. So when you take the profits and buy another contract whenever you are able to, And you keep doing that every time you're able to buy. That's called pillaring. But when you take the profits and buy at 358, you're able to buy another contract. And then you just say, well, how much it takes for me to be able to buy 2 contracts? And then how much would it take? At what price can I buy 4 contracts? And then at what price can I buy 8 contracts? That's called pyramiding in the market. And then when you just buy one, every time you can buy one, that's called pillaring. Pillaring. Pillaring is when you buy a contract every time you're able to buy one. Pyramiding is when you're doubling, almost like compounding. Does that answer your question, Ori?
Awesome. Thank you so much.
You're welcome.
That was interesting.
Tracy?
Hello, everybody. These have been some great questions. We are at 8:30 now, hour and a half, and you know, we're recording these so that you can be able. My suggestion is for everybody to go back and look at the videos, because the more you hear it, the better you will understand it. And so we don't want to get too long on these videos. We got a lot to marinate on.
Okay.
So I think that they're very good questions, and would like for you to relook at the videos and come back next week with more questions if you have them. So if it's okay with you, Delvin, if you want to, I want to thank everybody on the platform. Great job. And if you want to end the call, Delvin.
Do we have any homework?
Yeah, homework.
Yeah.
Yes, we do. Can we go over homework, Tracy? Or can we do that?
Yes, you can do homework.
Okay.
We just don't want to overload everybody's brains. You know, give them something to marinate on.
Thank you, T.
Well, I did tell you guys we was gonna bring it on Sunday because I will be able to sit down somewhere and not be driving. We're gonna give you a little more on Sunday.
Well,
So,
you brought
Good.
big time. Thank you.
yeah.
It
So
was great.
I don't know if Eric had some things he wants you to do, but I do have a little homework I wanted you guys to do to prepare for the next call. And this is really something you need to be doing. And that's since we're talking about the grain market so much, I'm gonna reiterate again. That's my favorite market, guys. That's where I've made most of my money at. That's kind of like the market that I'm not gonna say master because I don't feel that nobody mastered anything in the market. I don't feel that there's no experts, no gurus, because once you go to that mindset, you just put yourself in a dangerous mindset in the market when you start thinking you're an expert or a master or a guru, because these markets will introduce themselves to you. And they will let you know quick that you're not a master of nothing. So with that being said, I want you guys to understand that because we're talking about the grain so much, that season is coming up. That's why I keep talking about it. And we're going to get a chance to paper trade and then probably get everybody into trading for real at some point during the grain season. So my homework to you guys, since this is something that I'm going to be talking a lot about, is I want you to learn what is the corn belt. Corn belt. I want you to look that up and I want you to learn what the corn belt is. I also want you to look up what is the plain states. When I say plain, I'm talking about plain like PLIN, plain states. What states are those? What states are considered the plain states? What is the corn belt? And last, I want you to look up what is the heartland. You may have heard of the heartland. Where's the heartland and what is the heartland? These are something that you need to learn and understand when you're trading the grains. They're gonna come in a lot handy. Very important down the road. What is the heartland? What is the corn belt? And what states are considered the plain states? Got anything, Eric, you want to add? But that's the homework I wanted to give everyone.
So we're going to become weathermen, huh?
I would just say, you know, for me, everybody determine what type of trader you want to be. I mean, there's two types of traders. There's a technical trader and a fundamental trader. You have to determine what type of trader you want to be. I mean, because it's very important. It's very important when you go to make your decision, how you're making your decision. So I would say, for me, I would say, you know, research a fundamental trader, which is a trader who basically makes their decisions off of, you know, the news, events, and different things that may travel around the world. And a technical trader being, whether you want to be that trader who wants to look at charts, you know, you want the charts to dictate your decisions and history to dictate your decisions on past experience. So I think it's very important to determine what type of personality you have when it comes to trading.
And I'll add to that, for anyone who's new on the call, if you look on our chat, our homework for week number 9, video number 3, commodities trading, the Smithsonian channel did a real good documentary on that. And also too, you'll see that there are definitions, and one of the definitions what he just mentioned, technical traders versus fundamental traders.
All right, man.
Tori,
Well,
you own it, aren't you?
So y'all
Thank
get,
you.
Own it,
once
dog.
again,
Own it.
guys, y'all are hearing that being reiterated by all 3 of us. Jimmy mentioned that to you. I've mentioned that to you. So you see that right there, we're kind of all thinking the same way. So knowing what kind of trader you are, knowing when you're trading the market, that's real important. And that's something you will, you know, get better at, knowing who you are. Like I told you before, once you start paper trading, you'll get a feel and learn which makes you, which one you are, what makes you make a decision. Technical, fundamental, or sometimes you could be a little both. So that's important. Great point, Eric. So that's the homework that we got. And I'm glad everybody had time, took out the time to come on y'all Sunday evening, take away from the family what you had going on.
So next call, Delvin, next call.
This will be on YouTube, guys, on my YouTube channel. But I want to say the next call, can we shoot back for that Thursday again at 7 p.m. Eastern time, Eric? Would that be good for you? What you look like on Thursdays?
No, I'm flexible. I'm very flexible.
Okay. Thursday again at 7 p.m. Will be the next call, Eastern time. And that's all we got for tonight.
Okay, Tracy,
that
you
was a
can
lot.
stop the recording.